Okay, so today's lecture is on business acquisition, right? So here in a business acquisition, we have a scenario where a business takes over another business, a business buys over another business. So usually for exam questions at A levels, the situation is a limited company buying over a sole trader, or a limited company buying over a partnership, or a limited company buying over another limited company. Okay, but more of limited company buying over sole trader and partnership. Okay, not so much of the third one I explained. So if you understand how it works for sole trader, the concept is the same for partnership, right? So here you have what is happening here is the buyer is buying over the business of the seller. Now, this sounded somewhat similar in partnership dissolution where the business is closed. That is a scenario where the business closes off and sells their assets. So that's not what we're talking about because this has been discussed in partnership dissolution or sole trader dissolution in the earlier chapters. Today, we are going to look at the seller sells off their business. There's a difference, because in this situation where we learned in partnership dissolution, the seller sells off their assets to random people, gets the money, and then uses the money to pay the liability and to pay off the partners. But here, they are selling the entire business to a particular buyer. So you will be told who the buyer is. Whereas when they sold their assets, you're not told who the buyer is. It's all random people. So here, today what we're going to do is this scenario, where the seller sells their business to a particular company. Okay? So now in this chapter, there will be goodwill. I'll tell you later how to calculate goodwill. And when we get goodwill, this time we have to keep goodwill in the books. We have to record goodwill in the books. It appears under non-current assets. Okay, unlike in the past chapter in partnership changes and merger, we do not keep goodwill in the books. That's because in this chapter, the goodwill that we're talking about is called purchase goodwill. Okay, so for this chapter, you need to know some important terms. Okay, number one, purchase consideration. Purchase consideration is the term we use for the buying price. The buyer pays the seller to buy over the seller's business. How much they pay, that is the purchase consideration. Basically, it's the buying price. So when the buyer pays the seller, this payment can take place in a variety of forms. Okay, number one, the buyer can pay in monetary form by cash or check, or the buyer can issue shares to the seller. So the seller becomes a shareholder in the buyer's company, or the buyer can issue debentures. So the seller becomes a non-current liability in the buyer's company. So the question will mention clearly what are the modes of payment. Okay, and then another term we have to know is the fair value of net assets taken over. See, when the buyer buys over the seller's business, the question has to tell you which elements of the seller's business that the buyer is buying over. When I say elements, I'm talking about the assets or the liabilities of the seller. So the seller will have their non-current assets, they'll have their current assets, they'll have their trade payables. So the question will tell you which is taken over and at what value. Okay, two things. What is the net assets taken over and what is the value? So that's why I mentioned here, you must be very careful to include only whatever assets or liabilities taken over and at what value. So these are the two things. So most of the time, the question will tell you at what value the buyer is taking over. But if no value is given, then we follow the seller's SOFP value. We refer to the seller's statement of financial position. Whatever stated in that statement of financial position, that's the value of the assets and liabilities taken over. So all this I'm mentioning, I will explain through a question later and you'll be more clearer once you go to the question. Okay, now thirdly, you need to know about goodwill. So this goodwill, this is the only chapter where goodwill is kept in the books. All right. So goodwill here is the difference between the buying price, purchase consideration, and the fair value of net assets taken over. Okay. So basically, if the purchase consideration is more than the fair value of net assets taken over, then we have a goodwill in the buyer's books. Goodwill is recorded in the buyer's books, yeah, not seller's books. If, like for example, if the value of the assets, net assets taken over is 100,000, but the buyer pays 120,000, so the buyer is paying extra 20,000. That extra 20,000 is the goodwill. Okay, so if the purchase consideration is lesser than the fair value of net assets taken over, then this is referred to as a negative goodwill or capital reserve. But nowadays, most questions, they don't ask you this way already. Okay, the third scenario, if the purchase consideration equals to fair value of net assets taken over, then there's no goodwill. So most likely in an exam question, only situation 1 applies. Okay. Situation 3 will not apply. I mean, I just put that for your knowledge, because otherwise they want to test you on goodwill. If situation 3, there's no goodwill. That's why they won't ask in this situation. Situation 2, I think it's too heavy. They don't really test you any. So you just have to focus on situation 1. Okay. All right. So as I said, in this chapter, goodwill is retained in the books. So because goodwill calculated here is referred to as purchase goodwill. Okay, this means that the goodwill has been paid for. That means the buyer paid to the goodwill. So that's why it should be retained in the books. So here I've mentioned that the previous goodwill that we learned is referred to as inherent goodwill, okay, which is not paid for. That's why we do not keep it in the books. If you recall, we bring the goodwill in using an old ratio and we remove it using new ratio. So for this chapter, we're not going to do that. If there's a goodwill, we're going to show it under the non-current asset section, intangible. Okay, so this is the formula. Okay, so the important equation that you must know in this chapter is purchase consideration, which is the buying price, minus fair value of net assets taken over. So this is where you include only what is taken over and at what value. So these two difference is the goodwill. Okay, so now for this chapter, the question you can be asked to prepare the following. For seller's books, you can be asked to prepare the realization account or capital account or cash and bank account, similar to what you did in partnership dissolution. This is to close off the seller's books. But in the buyer's books, they can only ask you to do one thing, which is prepare the SOFP of the buyer after the business purchase. Okay, so this slide contains reasons why a sole trader's business may be sold as a going concern, because the money might be good, right? Okay, maybe the sole trader doesn't want to continue business. Okay, and the buyer prefers so because it saves them from all the problem of building market share. That means rather than to start from scratch, create a new company, they might as well buy an existing company. Okay, because the existing company might have their own client. So this saves the buyer the headache of, looking for new clients and so on. Okay, so as I mentioned earlier, limited company can take over the business of sole trader or partnership or another limited company. Okay, this I've mentioned just now. Okay, now I'm going to expose you to a scenario question. I'll keep it very simple. Okay, now I want to alert you in this chapter, you need to be very clear who is the buyer, who is the seller. Okay, let's look at this example. So a limited company, D. Lucas Limited, takes over the business of a sole trader, Brown, except for the bank balance. So this is the part where you need to be clear. The buyer is Lucas the seller is brown. And in this sentence, they also told you what are the items taken over. Okay, they take over everything except the bank balance. Okay, so for this example, the goodwill figure is given at 8,000. So later you need to fall back to this equation here. See, the goodwill is given, and we know what's the fair value of net assets taken over. So we can work out the purchase consideration. So the purchase consideration will be goodwill plus fair value of net assets taken over. Okay. Now, where are the values of the seller's assets and liability? Okay. So in the next slide, you're given the seller's SOFP. But before that, we need to know in what form does the buyer settle the purchase consideration. So situation one, D. Lucas, the buyer, agreed to pay cash. So in situation one, we're looking at the entire purchase consideration is settled by cash. Okay, let's see how this works. So this is the seller's statement of financial position before they sell off the business. This is the buyer's original statement of financial position, okay, before they buy over the seller's business. Okay, so now what we have to do is we need to calculate the purchase consideration. That's the first thing. So the fair value of net assets taken over is 42,000. So I reminded you just now, if no fair value is given, then we follow the value given in the seller's SOFP. So these are the values. So since everything is taken over except the bank, so when you add up all the assets, as in 30,000 plus 8,000 plus 7,000 and minus 3,000. Why should I minus? Because net assets. Net asset means assets minus liability. Okay, so you'll get 42,000. So therefore, that's the fair value of the net assets taken over. And goodwill is given as 8,000. So adding this, so the purchase consideration is 50,000. So in this situation, the buyer pays the 50,000 entirely in the form of cash. Okay, so how does this look like? Now remember, this is the buyer's original SOFP. So these figures are copied here. These are copied from there. Okay. Now, what you need to take care is, you need to take care that here, what you put here balances. That means follows the accounting equation. Okay. So how does this work? So the buyer is taking over the seller's fixtures at 30,000. So these values, 30,000, 8,000 for inventory, 7,000 for trade receivable, all comes from here. Seller's SOFP. Okay, and then the trade payable. So these are the values which we will add on to the buyer's original SOFP. Okay, then the buyer pays by cash. So 50,000. So 54,000, you need to minus 50,000. Okay, and then the goodwill was 8,000. So once you've done this, you just have to total up horizontally. Okay. Now, usually I will tell students this. It's a good idea that we are able to record what is taken over in the journal form. So once again, show you. Okay, what the buyer takes over is sellers, fixtures, inventory, trade receivable. So I'll put that here. Okay, since these are coming into the buyer's books and they are assets, so assets increase, so we debit. Okay, 38 and 7,000. Now, at the same time, the buyer is also bringing in goodwill into the books because the buyer paid 8,000 extra. Okay, the buyer paid 50,000. So when you put a journal entry, you must make sure that the journal entry balances. Okay, so the other extra part is the trade payable. The buyer is bringing in the seller's trade payable. That means the buyer will pay off the seller's trade payable of 3,000. Okay, can you see these two balances? So this is the important part that you should be able to do. When you attempt a business purchase question, please write this in journal form. And these are the figures that you're going to add on to the original SOFP of the buyer. And then you total up horizontally. So the answer would be this, the buyer's SOFP. So this is situation 1. Okay, situation 2, everything being the same, but now they tell you that Lucas has agreed to issue 50,000 shares of $1 ordinary shares at par. At par means no premium, okay, to pay for the net asset taken over. So just now, the payment was made in the form of cash. So now it's in the form of issuing shares. So everything here will be the same. No change. But if you notice, bank, there's nothing here because now the buyer doesn't pay out money. The buyer issues shares. So when the buyer issues shares, the capital will increase. So we will add 50,000. So when you check the accounting equation, what I've circled here, assets minus liability would be equals to 50,000. That should balance with this. Okay, once you ensure it balances, then you total up horizontally. And you get the answer. Okay, third situation, the buyer agrees to issue 20,000 shares of $1, but here they didn't use the word par. So it most probably there is a premium. Okay, and then cash 20,000. So when they tell you like this, the total purchase consideration, remember it was 50,000, you need to deduct cash 20,000. So the balance is 30,000. So the buyer issues 20,000 shares of $1 and the value is 30,000. So in this case, each share value is 30,000 divide 20,000. So which means each shares are issued at a price of $1.50 share. Okay, so that means there's a premium here. Okay, so the SOFP would look like this. Okay, this is the original SOFP. Okay, there is no change here. Sorry, there's no change here, but remember they paid money 20,000. So the balance 30,000, they're issuing shares at premium. So how do we get 20,000 here? It's 20,000 shares multiply $1. Okay, and how do we get 10,000? It's 20,000 shares times 50 cents. Okay, it works like this. In this scenario, total to be paid is 50,000. Okay, then paid in the form of cash 20,000. So which means the balance to be paid is 30,000. So this 30,000, they'll issue 20,000 shares. So therefore, the value of each share is 30,000 divide 20,000 shares, which gives us $1.50. So since the nominal value per share is $1, therefore the premium per share is the balance, 150 minus $1. So 50 cents. So which means, how did I get the capital 20,000 is number of shares issued times nominal value per share. And how did I get the 10,000 share premium is number of shares issued times premium per share. That's all. Okay, so this is the concept. When a limited company takes over the business of a sole trader, the same concept is used for partnership. So we'll do some question now. Okay. Okay, question 2. Okay, this question 2 is actually a past year question coming from 2009 October, paper 42, question 1. So here, the balance sheet of Draka was given. So since this is an old year, so they use the old term balance sheet. The new name is statement of financial position. Okay. And fixed asset is the old name for non-current assets. Stock is the old name for inventory. Debtors is the old term for trade receivable. Okay, creditors is the old term for trade payable. Okay. So now what we are given here is the statement of financial position of the buyer or seller. Let's find out. Draka Limited acquired the, oh no, sorry, this is, oh yeah, okay. So Draka Limited acquired the partnership of Amir and John before the start of the business. Yeah, okay. So it says here Draka Limited acquired the partnership of Amir and John. So which means Draka is the buyer, Amir and John are the sellers. Okay, so the partners shared profits and losses in the ratio 3:2 respectively. Okay, so this is the part where you're told what the purchase consideration is, 150,000. And this is the part where the question tells you in what form the purchase consideration is paid. Okay, so it is settled in the form of shares, debentures, and cash. Okay, so the shares in Draka Limited were distributed in profit sharing ratios. So, which means these shares, how much goes to each partner, we will follow this ratio, 3:2. But the debentures were shared equally between the partners. Okay, so this section is the, so this section was the SOFP of the buyer. This section is the SOFP, the original SOFP of the sellers. Okay, and then this is the part where the question tells you what is taken over. So this is where, since they've given it an amount, you see, fixtures and fittings, the buyer takes over at 40,000. But then when you look at the seller's SOFP, it is stated here as 50,000. So we always follow the revalued amount. This is the fair value. We don't follow the 50,000. Okay. So for fixtures, fittings, inventory, and trade receivable, sorry, fixtures and fittings and inventory, we follow these two figures. But for trade receivable, they said book value. Then we follow the seller's SOFP value, which is 17,000. Okay, so the company, which means Draka, also took responsibility for the settlement of the creditors. So this is the part where they're telling you that the trade payables of the seller is also taken over, but a value is not given. So whenever a value is not given, you just follow the seller's SOFP value. Okay, so part A, you are asked to prepare the closing entries on the seller's side. So they said prepare the capital account. Okay, so but in order to prepare the capital account, one of the elements that we need is the profit or loss on realization. So although the question did not tell you openly, you still need to prepare the realization account, follow how you have been taught in partnership resolution. So the only difference here is that you will see this element here. Okay, all right, let's go to this. So see, so you need to remove all these assets from the seller's books. So goodwill, fixtures and fittings, inventory, trade receivable. So those are the figures you see here. Follow the SOFP of the seller and then take out the trade payable. And here you got to put in the purchase consideration. Okay, so the double entry in the seller's books to record the sale of business is you credit the realization account and you debit the buyer's account in the books of the seller. Okay, so then you need to credit the buyer's account and debit the capital account. So this section tells you how the buyer pays. Okay, okay, let's see how to get these figures. Okay, so now the buyer pays $10,000 in cash. So what we do is you credit Reka, who's the buyer, and debit the bank account, 10,000. Okay, not forgetting to put the opening balance. Okay, then 20,000 debentures at par. So the cash goes straight to the bank account, not directly to the partner's capital, but the shares and debentures goes directly to the partner's capital. So $20,000 in par, debentures at par. So we credit Reka with the debenture, 10,000. See, it's 10,000 each because the question says that the debentures are shared equally among the partners. Now, if you notice, from this purchase consideration, I deducted cash and debenture at par first. I didn't deduct shares. Why? Because cash is fixed. 10,000 means 10,000. And here debenture, they use the word par. So there's no premium. So whatever is fixed, you deduct that first. So 150 minus 10 minus 20 is 120,000. 120,000 is the value of 50,000 shares. So therefore, we need to work out the proportion. How much of the 120,000 is goes to Amir and how much goes to John? So this is where you break up the 120,000 into 3/5 and 2/5. So in doing that, 72,000 goes to Amir, 48,000 goes to John. So when you credit here, you have to debit their capital. Okay, for the shares and for the debentures earlier. So this is the opening balance coming from the seller's SOFP. Okay, so this is the profit on realization. So once you've completed all this, you balance up the account. So the business, the partnership has to pay Amir 10,800 and has to pay John 7,200. So we debit capital for that and we credit the bank account. So if you have done everything correctly, the bank account should balance up. Okay. All right. Now let's look at The next section. Okay, which says prepare the statement of financial position of Draca. But before that, we need to read this. In order to finance the acquisition of the partnership and plans for future expansion, a rights issue of 1 new share for every 5 was held. Was made to the original shareholders of Draca. So original shareholders of Draca means excluding Amir and John. Okay. So the shares were issued at 250 each, and the issue was completed successfully, and there were some issue expenses. Okay, so which means Draca has to pay 30,000 in issuing the shares. Okay, let's see how it works here. So see, the purchase consideration was 150,000, right? From here. Okay. And then the fair value of net assets taken over is 63,000. So how do we get 63,000? Here's the working. Add all this up and minus 12,000, you get 63,000. So these two difference is the goodwill. So the buyer paid 150,000 for something worth 63,000. So which means the buyer paid extra of 87,000. This extra of 87,000 is goodwill, and it should be kept in the books. So it should be recorded under the non-current asset section, intangible. So that's how I get goodwill 87,000, which means you need to show your workings here. Okay, how to get the goodwill. Okay, and then how do I get 830,000 for non-current asset? Okay, if you look at the buyer's original SOFP, the non-current asset shows 790,000. But here it shows as 830,000. So there's an extra 40,000 coming in. So that 40,000 is this one, the non-current assets taken over, which is here. This one. This is a non-current asset. So like I said, the original SOFP for the buyer, you just add on the revalued amount. Yeah. Okay. So that's how we get this figure. Okay. And then inventory. Okay. Go and check the buyer's original SOFP. The original SOFP shows inventory to be 38,000 here. So 38,000, we need to add 18,000. So then we get 56,000. Okay, doing the same for trade receivable. The buyer's trade receivable is 68,000 here, plus seller's trade receivable at book value. So plus 17,000. So we will get 85,000. Okay, now as for bank, how do we get this? So I've shown the working here. The original balance, bank balance in the buyer's SOFP was an overdraft. Okay, let's check it out. Okay, this is the buyer's original SOFP. Can you see the original balance is an overdraft. So this is negative 21,000. And then remember the purchase consideration was paid in cash. That's one of the modes of payment. They issued shares, they issued debentures, and they paid cash. So that's another 10,000 out. And then money came in by issuing shares, price issue. So how do we get that? It says here, the original shareholders, 1 share for every 5. So you need to determine what's the original number of shares. So the original number of shares is 500,000 divided by 1. So there were 500,000 shares. So 500,000 times 1/5. So that's 100,000 shares at 250 each. So the money they receive is 250, and then minus the issue expenses. Here, minus 30,000. So all in all, the balance changed from negative 21 to be 189,000 positive. So since it's positive, so we record it under current assets. Okay. Now, as for the share capital, we have the original 500,000 plus Amir and John. Okay. So Amir and John, 50,000. Okay. And the rights issue. Okay. So which means original SOFP balance 500,000, and then shares issued to Amir and John, 50,000, and then the rights issue 100,000. So adding all this together will give us 650,000. Okay. Now, how do we get the share premium? 220,000. We need to check the original SOFP. Does it contain share premium? No. No share premium. But then the shares issued to Amir and John. Okay. It was how much? 150 minus 20 minus 10. 120. So each share is worth $2.40. Show you the calculation here. Okay. Show you once again. 150,000 minus 20,000 minus 10,000 is 120,000. So 120,000 divided by 50,000 shares. So each share is worth $2.40. But not forgetting the nominal value was $1. So we need to split the 240 into $1 nominal and $1.40 premium. So which means to calculate the share premium, okay, number of shares issued to Amir and John. So purchase consideration, 50,000 shares times premium per share. So this will give us 70,000. And then from the rights issue, we issued 100,000 shares times, okay, there the premium is different. The premium is issued at 250. 250 minus 1, so $1.50. Okay, so this will be 100,000 shares times 150 per share. So adding both of this, we will get 220,000. So that's how we get the share premium of 220,000. Okay. So as for the retained earnings, if you notice the original buyer's SOFP, you have 224,000, but because we are deducting the expense is 30,000. So that's how we get 194,000 as I've shown here. The original balance minus the share issue expense, so we get 194,000. Okay, and the debentures came from here. 120,000 plus 20,000. Okay, so that's how we get 140,000. And finally, the trade payable is the Draca's original trade payable, which is 31,000 plus 12,000. So therefore, we get 43,000. So that's how we get the SOFP of the buyer.